How's it going, everyone? It's Sam. I want to give you an update on a stock that I just bought, and that's Corsair Gaming. Now, they reported earnings today, and they fell significantly. They fell, I believe it was down 8 or 9% at one point. I bought around this price range now, and then I bought when it was even further down. So, I want to talk to you about them today, why I think they're falling, why I'm not worried about it long term, and why I'm excited to own the stock because I have been watching it for a while. Tom Nash has talked about it. Financial Education has talked about it. There have been a number of people on YouTube that have talked about it. It's in that price range too, where there's just a lot of upside potential. It's $2.7 billion in market cap. I think a lot of people on YouTube like to talk about that mid cap range, 2 to 10 billion, even below 2 billion too. So anything below 10 billion, a lot of people are excited about because, for example, Corsair Gaming, Tom Nash says, hey, I think it could go up to $62. We can also see here, according to TipRanks, analysts are saying the highest price target is $55, the lowest is $47. They're pretty excited about this. They think that this is a stock that could easily 2x. Now, I want to tell you about it here today, walk you through some of the numbers, why it's pretty exciting, and again, why it fell here today. Now, just like Tom Nash likes to say, don't click nothing, don't smash nothing. However, I did tell my Patreon about it, and we are up a couple percent. So if you want to hear about that, it is at the beginning of the month here, August 3rd. So you get the most bang for your buck here. Definitely check that out if you're interested underneath the video. Now, Corsair Gaming, $27.14. Why the heck did it fall so much? It's because of their earnings. So we can pull it up here. They missed on revenue by about 2.3 million, and they missed on earnings per share of only about 0.36. This is adjusted earnings, and it fell shy of their estimate of 0.39 per share. Now, why this happened was because of the pandemic, they say. They experienced higher than expected costs for logistics, and we expect logistics costs to remain elevated in the third quarter. Shutdowns from the ongoing pandemic in several large regions we operate in also negatively impacted our operations. Now, they continue, though, to give their expectation of 1.9 to 2.1 billion this year in revenue. Now, I think overall, there are a couple things to pay attention to here. First of all, the pandemic is actually getting worse. So a lot of areas are shutting down, like they said. However, they should be getting better at adjusting to this, right? So they said it was higher than they expected. So maybe it negatively affected them. Maybe they could do something better this quarter. They expect this to remain high. So hopefully they're looking for other solutions that will lower the cost and help their margins. Now, if it does get worse, I would think there would be more demand because we are getting closer to winter, right? We're getting into the fall. It's going to get colder. The pandemic is raging, so more people will be shut in. So I would think the demand would be higher for their products. Now, maybe they sold so many that it's difficult for them in the future, but that's the case for so many companies, right? So many hardware companies. I mean, you can talk about Apple, right? Where they sell a ton of phones. A lot of analysts think that they won't be able to sell that many phones in the future. And remember, this was going into the summer months. So people were going outside. A lot of the country was reopening from April to June. So you have to realize that this will probably go up here in the winter. Now, let's take a look at some of their numbers here because they have been growing quite nicely. Now, again, like I said, analysts are expecting a nice high price target. If you guys want, you can actually check out the link down below to TipRanks. I really like using it, and I'm working with TipRanks, but I was using this before I started working with TipRanks. The nice thing is here, you can see some of the risks, and you don't have to go and dig really deep. You can kind of just look at the risk section and figure out why or why not people are investing in these kinds of companies. So overall, investors are pretty bullish on this company, even though it had some negative news today. Now, this sentiment was up until today. It's going to be interesting to see because obviously people are selling off. But when you look at the company itself, they've been growing quite quickly. So this is quarterly. They've been growing over the last 3 or 4 years pretty consistently. Now, the last 2 quarters, they've actually gone down. But remember, they had blowout earnings, right, back in December of 2020. So looking at this, though, they still have been positive earnings per share for the last several quarters, really the last 2 years. Before that, they were just barely negative. So the fact is, this is not a company that I consider very high risk. Even though it's under $3 billion in market cap, I don't think of this as a high risk company because they're already positive. They're still a positive earnings per share, and they're going to continue to grow this moving forward. If we look at their financials too, and we compare them to some of their sector, right? Price to earnings is actually very low. So moving forward, it's around 15 to 16. The sector median is 25. So this is very undervalued in this way, right? So it's very undervalued there. If we look at the sales price, the price to sales ratio is 1.5, which is very different compared to the 4.6 of the median in the sector. So if they actually went by these numbers, this would be close to an $80 stock. Now, we can take a look at some of their financials too. I always believe it's important to take a look at financials. If we look at the balance sheet here, that's what I really want to talk about. They have $122 million in cash and short-term investments. They have total receivables of $304 million. And then they have current liabilities of about $500 million. So accounts payable, 272 is the majority of that. So overall, their current ratio is not 1, but when you consider the fact that they have a large amount of receivables, they have a large amount of cash, you subtract the current liabilities from that, you have, a little bit more in liabilities, maybe 80 million or so compared to what they have up here, which isn't great. I always like seeing a 1 current ratio, but the fact is they do have a lot of receivables that are coming in, and this isn't that much for a company of their size. They could easily get a credit line or raise some extra cash for this extra money. Now overall, Corsair has been going down pretty consistently over the last couple months, and it's definitely been one that's been hurt recently. So you can see back in November of last year, they were up around $51. They also ran up to about $46 or so back in February. Since then, they've fallen a lot. So this has come down about 50% from its highs. Now, this is a company that's also in a growing sector, and it's pretty cheap compared to the whole market. So the whole esports market is growing at about 9% compounded annual growth rate. And the fact is, this has probably been escalated or increased because of the pandemic. Now, when you look at their price to earnings ratio too versus the S&P 500, the S&P 500 is around 35 right now. Their price to earnings ratio moving forward is about 16. Now, again, this is forward versus previous, but you can see that there is a big divergence, and this is in a very quickly growing industry. It's a quickly growing stock. It's got a good balance sheet. Everyone seems to be bullish on it, but it's falling today because of negative earnings this quarter and a negative outlook for next quarter. Overall, I think it could fall more, but if it does, it's just going to be a deal and a half. Right now, I feel like it's already a deal and a half. I didn't think it would fall down to the $26, $27 range, but it has. So the fact is, this is a company that I don't think will 5x, 10x in the next couple of years, like some of the other companies I have. Over the next 5 or 10 years, I think Tattooed Chef will 10x. I also think CleanSpark will 10x, assuming crypto does well. But I think this is a company that could easily 3x, 4x. It's going to be a quality company that's going to continue to grow, maybe a little bit slower than some of these other quickly growing companies, but it's also a lower risk in my opinion. They're selling hardware. They're going to continue to innovate, make new products. People are going to want to buy them. So that is my thinking on this company here today. It's already got a pretty low price to earnings ratio moving forward, and I was happy to pick up some shares. Now, like I said, do your own research. Thank you guys for checking out the links down below to TipRanks and to Patreon, and I will see you in the next video. Bye.